Okay, so something genuinely unusual is happening over at John Deere right now. Welcome to the Explainer, everyone. Today we're going to solve a bit of a financial mystery together. You see, when a massive cyclical giant like Deere releases its earnings, the market usually expects a pretty straightforward story. But their Q3 fiscal 2026 earnings report, it gave us a giant puzzle instead. Deere's overall earnings are recovering, but their biggest, most famous agricultural business hasn't actually recovered yet. So we're going to put on our financial detective hats today. We'll be examining the raw numbers, the business segments, and the market's incredibly sky-high expectations to figure out what exactly changed at John Deere. Let's kick things off with the headline number, and honestly, it looks absolutely fantastic. Deere just reported a staggering quarterly net income of almost $1.4 billion, well, specifically $1.379 billion. That is a solid 7% jump from a year ago. Revenue also ticked up 5% to over $12.6 billion, and earnings per share rose roughly 7% to $5.10. Now, normally, if you see these kinds of numbers, that would be the entire story, right? A strong earnings report should mean the company is firing on all cylinders. You'd pack up your briefcase and say, great quarter, Deere is back. But Deere is not a steady, predictable growth company. It is highly cyclical. Okay, let's dive into this, because right here is our first major clue. This is the central anomaly of the whole report. Overall profit shot up 7%, right? But Deere's absolute flagship segment, production and precision agriculture, went the exact opposite direction. Revenue for that core segment actively fell 6% to roughly $4 billion, and operating profit dropped 9%. So wait a second, how on earth does a tractor company increase its overall profit by 7% when its main farming business is actively shrinking? If the farming sector hasn't recovered, what is actually driving this massive earnings beat? To really wrap our heads around this, let's think about how a giant factory operates. Imagine a setup where your main, massive, heavy-duty engine is just sputtering. It's powering down. It's been a really tough year for that primary machine. But suddenly, a secondary, smaller motor kicks into overdrive out of nowhere and starts generating a massive surplus. When you measure the factory's total output at the end of the day, it looks like it improved. But that absolutely does not mean the main engine is fixed. And that is exactly what is happening at John Deere today. Total income is up, sure, but the main engine is still sputtering. So the real mystery here is, well, where on earth is all that new income actually coming from? While the core production and precision agriculture business is down 6%, Deere's other segments are totally picking up the slack. Small agriculture and turf revenue, that jumped 12%. And the real hero of the quarter? Construction and forestry. Revenue there completely rocketed up 18% to over $3.6 billion, generating $436 million in operating profit. So Deere isn't recovering everywhere. It's actually being carried by entirely different parts of its portfolio. And this brings us to a really fascinating twist. Why is construction suddenly booming for Deere? Well, part of the answer literally has nothing to do with farming, zero. Deere is unexpectedly benefiting from a totally different capital spending cycle. Management pointed out that construction demand is being driven by huge infrastructure projects, energy projects, and, get this, data center construction. No way, right? Yes, an agricultural equipment company is effectively riding the coattails of the AI tech boom. Because of this, they expect U.S. and Canadian construction equipment sales to rise 5% to 10% this year. But, that creates our next massive question. Think of Deere's main agricultural business like a giant bucket with a leak in it. Right now, the construction and small ag teams are basically grabbing hoses and pumping water into that bucket as fast as they humanly can. The bucket isn't emptying anymore, and the water level is actually rising. But did we actually fix the leak? What happens if that construction boom, which, remember, is also highly cyclical, slows down before the agricultural sector fully gets back on its feet? So let's map out this agricultural cycle. Deere's management believes that this year, 2026, is the trough of the equipment cycle, the absolute bottom. But listen closely to their actual forecast. They still expect U.S. and Canadian large agricultural equipment demand to fall 15% to 20% this year. South America, also expected to drop 15 to 20%. You see, a bottom doesn't mean a boom. It just simply means the bleeding might finally stop getting worse. A true, full-blown recovery is still just a forecast for 2027 or beyond. Which brings us to the motive behind how the stock market is behaving right now. Just look at this sticker shock. $634 a share as of August 2026. That gives Deere a massive market capitalization of around $171 billion. At this price point, the stock market is definitely not pricing Deere like a company in crisis. It's not even pricing it like a company that's just surviving a tough trough. When you buy a stock at this kind of valuation, you are making a very, very specific bet on the future. So the crucial point is figuring out exactly how we measure that bet. Right now, current estimates put Deere's trailing price-to-earnings ratio, or PE, at around 35 times. And their forward PE, which is based on what analysts expect them to earn down the road, is roughly 27 to 28 times. For a cyclical industrial company which typically trades at way lower multiples during a downturn, that is a really demanding, expensive valuation. The market is effectively completely looking past the current agricultural slump. Investors are paying a premium today, for sure, because they are absolutely banking on a massive earnings recovery tomorrow. Now, you might be sitting there thinking, well, hey, I'll just buy it, hold it, and collect the dividend while I wait for farming to bounce back. And sure, Deere pays out $6.48 annually per share. But at a share price of $634, that is a dividend yield of only about 1%. It's a safe payout, sure, but 1% is simply not going to protect your portfolio if the market got the valuation wrong. Deere just doesn't offer enough passive income to automatically compensate for delayed recovery. You are buying this for capital appreciation and future earnings growth, plain and simple. All right, let's weigh the evidence, because the clues here are unusually balanced, which honestly is exactly what makes this such a fascinating financial detective story. We need to look at both sides. We're going to weigh the strongest arguments of the bulls, the folks who think the stock is a screaming buy, against the bears, the ones who think the market is getting way, way ahead of itself. Let's start with the bull case, which is actually remarkably strong. If 2026 really is the bottom, any modest improvement in farming is going to create massive operating leverage. In the meantime, construction is expected to grow an unbelievable 20% this year, and small ag by 15%. They expect to generate a massive $5 to $5.5 billion in equipment operating cash flow. Plus, Deere's technology mode is getting so deep. They have 1.2 million connected machines out there. They aren't just selling tractors anymore. They are fully transitioning into a recurring technology and software ecosystem, and that is a powerful safety net. But then there's the uncomfortable bear case. We have to look at the risks. Production and precision ag sales are still expected to drop another 10% this year. Even more concerning, their operating margin for that specific segment is crashing down to just 11% to 12%, which is a huge drop from over 15% back in 2025. And then there are the looming tariffs. Reuters reports Deere expects tariff costs of roughly $750 million in 2026, and that balloons to a whopping $1 billion in 2027. If earnings disappoint because of these shrinking margins or those massive tariffs, the stock could suffer a brutal double whammy. Lower actual earnings combined with the market aggressively punishing that high 28 times valuation multiple. So we have all our clues laid out. We know construction is doing a lot of heavy lifting and inflating current profits. We know the core agriculture business is still scraping along the bottom. We know the stock is priced for an absolutely perfect recovery, and the dividend isn't going to save you if things go south. So to solve this mystery and figure out if Deere is actually a good investment right now, what is the single most important number you should be looking for in their very next report? It's not overall revenue, and honestly, it isn't even the stock price. The absolute smoking gun here is the production and precision agriculture operating margin. Right now, like we said, it's hovering around 11 to 12%. If in the coming quarters you see that margin stabilizing and finally moving back up toward its historical levels, then the agricultural trough is genuinely becoming a recovery, and the bullish thesis is totally intact. But if those margins stay compressed, while construction inevitably cools off, well, the market might just realize it demanded too much way too soon. So I'll leave you with this thought. At $634 a share, are you buying the reality of John Deere today, or simply a very, very expensive anticipation of tomorrow?